Hello, everyone. Thank you for joining us for today's event featuring Terence Keeley speaking on his book Sustainability Moving Beyond ESG to Impact Investing. My name is Srish Chatterjee, Professor of Finance at the Gabelli School of Business and the Gabelli Chair of Global Security Analysis at Fordham University. On behalf of the Gabelli School, a very warm welcome to everyone. In the last several years, the Gabelli Center and our wonderful co-presenters, the Museum of American Finance and the CFA Society of New York, have sponsored more than 50 events that have drawn close to 9,000 attendees. We are tremendously proud of this dynamic collaboration, and a full archive of our video content will be shared with you in the thank you email that you will receive. In just a moment, David Cowan, President and CEO of the Museum of American Finance, will give a full introduction to our speaker. Let me mention, by the way, that in the coming spring semester, Fordham will offer a course in financial history named Booms, Bubbles, Busts, and Crashes, and it'll be taught by David Cowan, and renowned economic historian and former board chair of the Museum of American Finance, Dick Silla. Mr. Keeley will speak for about 40 minutes, at which point he will address questions submitted through the question field that is located below the video player. Please feel free to submit your questions at any point during our event. We will try to address as many of them as possible in the Q&A session. All members of today's event, all attendees of today's event rather, will be receiving digital copies of Terence Keeley's book with information coming to you following our event. And now I'm delighted to turn it over to my good friend David Cowan, President and CEO of the Museum of American Finance.
Sarish, great to see you, all our friends at Fordham Gabelli and the CFA. Our author today has a 4-decade career in finance, advising everything and everyone from family offices to sovereign wealth funds. Until a few months ago, Terry was at BlackRock before starting to lead 1.6 LLC. My favorite client story about Terry is that a dozen years ago, he was appointed by Pope Francis to be a senior advisor to the Vatican Financial Reform Commission. And picking up on that theme, last year he was honored by CIO magazine, who said, quote unquote, Keeley has been called upon by kings and priests during their times of trouble and walked them back to financial health. Now he has turned his attention on how to walk, or even better, how to run to a healthy planet. In the past 6 weeks, Terry has several op-ed pieces in the Wall Street Journal on the topic, and then there is the book. At its core, it's a financial book about the benefits, perils, and the improbable promises of ESG investing. The numbers are staggering: $8 billion a day moving into ESG. And there are a lot of claims of those who promise the elixir of great returns combined with responsible companies. But ESG is complicated. It's a great catchphrase, but in the book, Terry will pull back the curtain on so many things, from benchmarks that have self-reporting to analyzing the verbal commitments of the CEOs to see if they are real or greenwashing, are showing factors for hardwiring corporate goodness like B Corps and Just Capital that can lead us to a purpose-led company. He addresses problems and solutions and how business, government, and community can work together. One of his maxims that I like that's buried in the book, it's in the middle of the book, is an enhancement of the old buyer beware to Terry's proverb, buyers beware regulators. On page 136, he ends chapter 8 with, quote unquote, are you ready for some excitement? I hope so, because the answers that are already emerging are not at all what you might expect. Well, yes, Terry, we are ready for some ESG excitement. It's my pleasure to turn it over to Terry Keeley.
Wonderful. David, thank you for those generous remarks, as well as yours, Professor Chatterjee. It's a real privilege, a pleasure for me genuinely to join you, some of you during your lunch hour. I hope you will be able to multitask, enjoy a bowl of soup as we walk through what won't be 40 minutes. I will be speaking for hopefully no more than 30 so that we can maximize Q&A. David, I thought we had a very good Q&A in our practice room, and I think the audience might actually appreciate more give and take. Before I get into my prepared remarks, though, I'd also like to thank the Museum of American Finance, the CFA Society of New York, and of course the Gabelli School of Fordham for putting together this wonderful lecture series. I hope I can live up to it. You know, as I was preparing for this talk today, I was very mindful of the fact that a new group of protesters, Occupy Park Avenue, have been making life fairly miserable for the headquarters of BlackRock and JP Morgan this week, along with Extinction Rebellion and Stop Adani, who are insisting, absolutely insisting, that business and finance stop financing climate change, that it is their fault, and that somehow by shaming Jamie Dimon, Larry Fink, and their colleagues, that we can get on top of these issues which genuinely threaten the planet, genuinely threaten humanity. All we have to do is make business and finance stop it. And in fact, it was that tough question that animated me about a year and a half ago to take on this very, very challenging subject. The principal line of inquiry of my book is, what is the role of business and finance, the proper role of business and finance in resolving the very, very great social and environmental challenges of our time? What is it that they're supposed to be doing? What is it that they're not supposed to be doing? Obviously, a subsidiary question of that is ESG. ESG is the biggest financial phenomenon in history, involving more than, depending on how you measure it, $120 trillion in assets or $60 trillion in assets, and I'll get into that. Are these strategies actually delivering as they promised to help make the world a better place and generate good returns? We'll be talking about that. If they're not working, are there more effective strategies? And if business and finance do everything they should be doing, will that be enough? Or will we need additional roles played by consumers, by policymakers, regulatory agencies, and civil society at large, all the NGOs that are out doing it? What do we all need to do to ensure that humanity flourishes in this, our 21st century and beyond? I'm going to give three brief answers to those questions now. I'll go into them at a little bit greater length, but for those of you who wanted to come away with some sound bites, here they are, three briefly. To achieve optimal levels of human flourishing, finance and business are responsible for maximizing long-run shareholder welfare. Long-run shareholder welfare. This actual statement will disappoint stakeholder capitalists on the surface. As many of you know, stakeholder capitalism posits that the responsibility of business and finance, and BRT, the Business Roundtable also discusses this, is in fact to look after all their stakeholders, not just their shareholders, but also their employees, their communities, their suppliers, the environment. I diverge from that in my conclusion by saying that long-run shareholder welfare is in fact synonymous with stakeholder capitalism, and I'll give you a number of examples why. Point number two, are ESG strategies working as promised? Definitely not. ESG strategies have been a deep disappointment and perhaps even a distraction from the larger challenges that we have. And I'll be spending a little bit of time on not only why that is the case, but how they could be fixed. Finally, how does humanity achieve optimal levels of inclusive, sustainable growth? Well, I contend it is an all hands on deck affair. That is, in fact, business and finance have no magic wands to move the carbon clock backwards or to suddenly solve centuries of racial injustice, which clearly exist. No, they have roles to play in that, but they must be supported by public policies, by individual consumer decisions, as well as by the civic society, which I want to spend some time on. So those are going to be the three broad theses that I'm going to cover. Let's get into the very first one. What is the purpose of business and finance? And I start with a wonderful quote from Henry Ford. And by the way, I'm going to be giving you different tidbits over the course of the next half an hour or so of both books and podcasts that I recommend you take on if you have the same passion for these subjects that I do. This particular section, I benefited tremendously from David Senra's Founders Podcast, number 266, on Henry Ford. Henry Ford's quote in his autobiography: "Money comes naturally as the result of service." Money comes naturally as a result of service. In fact, service is the most used word, the most repeated word in all of Henry Ford's autobiography. What did Henry Ford mean by service? Henry Ford had an abiding obsession. His abiding obsession was to change the lives of as many people as he possibly could for the better, to genuinely, fundamentally transform how humanity thought of their prospects. First and foremost, through transportation. As we all know, it was Henry Ford that invented the assembly line that created much, much cheaper cars over time that made them available for every human being. But he also dramatically improved his communities. Think of some of these statistics. In 1908, a Model T cost about $25,000 in today's money. By 1916, it had dropped to $9,000. In 1914, on a single day, he announced that he was doubling his workers' salary from $2.50 to $5. Just said, we're doubling everybody's salary. It's 2x. He also vowed that he would continue to cut costs in production and lower the price of his automobiles until every working man and woman in the country could afford to buy a car on no more than 3 months' salary. Over the course of the decades that Henry Ford carried on his revolution, Detroit's population swelled from 300,000 in 1910 to 1.8 million in 1950. The best, most prosperous place to be in the world in the early part of the 20th century was in Henry Ford's Michigan. And when Henry Ford died in 1947, he was worth the equivalent of $200 billion, which would rank him number one or number two today, depending on how you want to mark to market Elon Musk's purchase of Twitter. Many of us would mark him down about 25 billion for that. So what's extraordinary is all of the obsession that Henry Ford had of improving people's lives, benefiting their community, changing how people could actually travel, all accrued extraordinarily to his own financial benefit. Now, what's interesting is what Henry Ford did was almost illegal. In what way? Well, in 1918, Henry Ford was sued by the Dodge brothers for continually cutting the cost of his cars when they could not actually meet the demand. The Dodge brothers said, hold it, we're shareholders in this company, and you are paying out, you are wasting our profits by cutting costs and paying people more. No, we want to have our maximum pay back. That particular case went to the Michigan Supreme Court, and Henry Ford lost. The Dodge brothers won. In actual fact, one of the challenges of stakeholder capitalism is that at its extremes, it is not legal. It is actually the responsibility of corporations to respond to their owners and their owners' interests, which is largely carried out through shareholder resolutions, the election of boards. Corporations, CEOs, they report to their board, and their board reports to their shareholders. The principal point I'm trying to make with this very long Henry Ford illustration is that it's actually not possible to say whether or not Henry Ford was a stakeholder capitalist or a shareholder capitalist. It's pretty clear he was both. So, of course, was Stephen Jobs, Jeff Bezos, Indra Nooyi of Pepsi, and literally hundreds of others of the greatest businessmen and women of our time. When brilliant business insights are conducted for the greatest benefit of the greatest number, employees, suppliers, communities, and shareholders always benefit. Now, does this mean business leaders are always right? No. And I appreciate that somebody mentioned, David, I think that I have a couple of articles out. I believe that they can be accessed somewhere on the website if you wanted to. This is a reference to the Fortune magazine article I published a week ago, which was entitled, "Was Milton Friedman the First Woke Capitalist?" He probably wasn't the first woke capitalist, but in fact, he was woke in his own way. I discuss, in fact, how since Milton Friedman's famous 1970 article, What is the Principal Responsible Business, which was to make profits, how in actual fact, a closer reading of that article shows that the necessity of business is to respond to its owners. The owners run those businesses. So how have shareholders since 1970 intervened repeatedly to change the calculus of how corporations are looking at their challenges and their responsibilities? Well, it turns out share owners repeatedly through stewardship have required businesses to sacrifice some short-term gains in exchange for better long-term outcomes. Let me give you some examples. In 1970, actually, the greatest financial bankruptcy in US history, Penn Central, took place. It was, in fact, the greatest bankruptcy up until Enron a few decades later. What happened after that? Well, shareholders actually found out that there was a lot of very bad accounting going on. So in addition, with the SEC, shareholders insisted that all corporations have independent audit committees. Independent audit committees became the rule. And this, of course, improved not only individual accounting practices, but bribery, any number of ways in which financial shenanigans were undermining the long-term interests of share owners. Executive pay guidelines and poison pill takeovers were also insisted upon by shareholders through shareholder resolutions. This was intended to solve the problem of Victor Posners. Victor Posners, as you all may remember, were these corporate takeover villains, candidly. They would buy corporations, strip them of their assets, basically pay themselves bunches of money, and leave a carcass as a result. In 1991 to 1993, CEOs of IBM, Kodak, Westinghouse, General Motors, and Amex were all fired by shareholders. Shareholders, even though the boards were saying these are our CEOs, shareholders voted in resolutions to kick the bums out so that greater growth could be insisted upon at these corporations. IBM, Kodak, Westinghouse, GM, and Amex, not exactly small corporations. And as you all recall, after the global financial crisis, a number of provisions were required, including compensation clawback provisions, and of course, stress tests on banks, again, sought by shareholders. In each one of these cases, shareholders intervened pretty much against the advice of the CEOs and the boards, saying, hold it, you are not being sufficiently attentive to our long-run interests, our long-term needs. We are going to force you to course correct. In recent years, a growing number of shareholder resolutions have involved environmental and social concerns. I mentioned two, for example. One was a recent decision by 81% of DuPont shareholders to require DuPont to actually calculate how many of its little plastic pellets end up in oceans, seas, and dumps around the world every year. So it so happens it's about 10 trillion. Why would DuPont shareholders require DuPont to do that? Well, one, they want the best possible outcome for their company, and they are insisting that they think harder about what their impact is on the environment. You may know that Carlsberg now in Europe no longer puts their six-packs into those crazy little circular things. They are actually glued together. There is no plastic that keeps together a Carlsberg six-pack in Europe. This is progress. Another example of a shareholder resolution of late that is forcing corporations to think about things that perhaps they may not want to with a longer-term horizon. In a recent vote, Wendy's shareholders, 95% of them, voted to require Wendy's to join the Fair Food Program. The Fair Food Program is something that many other fast food chains had already joined, but this particular program became very important during COVID because of the working conditions that were happening in any number of meat plants and other plants. This required that Wendy's insist and join that same program. The discussion on where stewardship is heading is quite a heated one right now, to the extent that any of you are really following the Vivek Ramaswamy versus Larry Fink food fight that's taking place in the Wall Street Journal these days. You'll see that Vivek Ramaswamy is trying to embrace the idea of capitalism is excellence, capitalism, and he casts Larry Fink as this woke, overly concerned social environmentalist. I would argue that Vivek Ramaswamy should be more careful than he's being. Why? Because it is absolutely clear to those of us who are following corporate progress that the idea of excellence and, let's say, corporate mindfulness or ESG alignment are very often synonymous. The reason why I've spent a little bit of time in this, happy to return to it, David, in Q&A, is that humanity will find its best interests are served as long as business and finance continue to maximize the long-term welfare of the share owners. Let's leave it at that. Maybe we'll come back to that question, Q&A. Dr. Gillian putting on, and happy to respond to that in Q&A, David. Second point, ESG strategies are not working as promised. Now here, if you've read my recent Wall Street Journal op-eds, including ESG neither does much good nor very well, which appeared in the Wall Street Journal on September 12th, or my more recent article, Why ESG Funds Fail and How They Could Succeed, which came out last week, I believe. Grab a cup of coffee, go get a soup, you know what I'm about to say. In brief, my beliefs and arguments can be summarized as follows. ESG, the largest financial phenomenon in history, involving somewhere between 50 trillion in dedicated assets or 120 trillion in integrated assets, depending on how you define it, is actually generating astonishing little tangible benefit. ESG investment strategies implicitly, and in some cases explicitly, promise to do well and do good. That is to say, produce market rates of return or better than market rates of return, as well as improve social environmental outcomes. But the bulk of evidence actually suggests they are doing neither directly. Let's do the data. From the third quarter of 2017 to 2022, ESG funds, broadly defined equity funds, have underperformed broader indices, and you can pick your index, whether or not it's the S&P 500 or MSCI Global. They have underperformed by astonishing 250 basis points per year, 6.3% versus 8.9% to be precise. This is an extraordinary amount of tracking error, negative tracking error. Moreover, an exhaustive recent study of the 15,000 corporations that have been involved in these various strategies, moving them in and out of ESG strategies, over the same 5-year period, the researchers at 4 separate universities concluded that there is no evidence to suggest that ESG funds are encouraging corporations directly to improve their behaviors. It turns out that these corporations would have taken many of the same steps that they've taken, many of the steps they've taken, whether or not they were included in an ESG fund or not. There is, in other words, no causality between undertaking socially, environmentally beneficial activities and desiring to get into an index. Now, this is actually something that has always been true. It turns out that divestment is a very, very, very poor tool for changing corporate behavior. And we know this because of decades of experience with what we call sin stocks. You'll all remember that sin stocks, broadly speaking, are a category that includes alcohol, tobacco, gambling, and firearms. For more than 4 decades, in fact, many religious institutions, public pension plans, other institutional investors have assiduously avoided these shares, all with the intention of maybe we can stop them from doing what they're doing. Well, you can still grab a smoke. It's pretty easy, unfortunately, in the United States to buy a gun. No problem grabbing a beer. And self-evidently, you can play roulette in any number of locations around the world. There is no correlation at all between divestment or an attempt to divest and the underlying activities. Another example, which is centuries old rather than decades old, is usury. I think many of you know that many religious traditions, including all Christian as well as all Muslim traditions for centuries required that there not be any payment of interest in borrowing. It was actually punishable by death from it. But during those centuries, the lending at interest, in fact, lending with interest always took place. In fact, arguably, the interest was higher because people had to go to fewer lenders to obtain the borrowings that they wanted. And of course, today, it is just the Muslims that maintain usury restrictions, although they also have ways to work around it. So what I conclude in these articles, and I'm happy to take it up for further discussion, is that ESG is actually being criticized from the left for being too timid. That would be what our Occupy Wall Street protesters are saying. ESG is just not being strong enough. We should divest more. And of course, on the right, the criticisms of woke is that corporations are being utilized for social tools. I say that we can have that discussion, but it's actually not critical. What's critical is that ESG strategies are failing on the terms that they have set for themselves. They have set out with the proposition that we can generate better risk-adjusted returns because of our greater mindfulness to the material risk behind environmental, social, and governance concerns. And by the way, we can help change or force corporate behaviors. It's very clear that that data is not being bared out. So what would be better than the current ESG strategies? Well, I'm grateful to Bill Gates, who had a CNBC interview last week, where he was specifically asked about ESG strategies, and this was his quoted response. I actually care a lot more about where people invest than where they don't invest. In other words, to move the planet from a pretty difficult situation, brown, social, otherwise, to better outcomes, it's primarily a story of investments, not divestment. And more importantly, when it comes to how shareholders can properly engage corporations to change, as we've learned from DuPont, as we learned from Wendy's, those pressures are likely to come from shareholders rather than those who no longer own the shares. Shareholders actually have the power. So active stewardship becomes more important than passive stewardship. It's also very clear, by the way, that the value additive process, that is to say, a corporation that it outperforms in terms of its value, its asset value, is likely to be one which is brown that moves to a greener format. And here, Vicky Holub's Occidental Petroleum is an excellent example. I can give you dozens more. So what I thought I would like to do to help illustrate where I think ESG could be improved is to, I believe, Nura, you have some slides for me, and if you could pull up slide number 1. So that's slide number 4. Could you go back to slide number 1? There you go. Thank you very much. So what you see here on the x-axis is measurable impact, what is known and what is unknown. This is verified measurable impact. And on the y-axis, the vertical axis, you see returns which are being expressed as a percent of an index. Red refers to all strategies that are ESG indexed. There are today more than 3,600 ESG indices that are maintained by the likes of MSCI, S&P, Bloomberg has their own lists. So anything that is relating to an ESG index, their performance relative to the index is going to be centered right around 100%, as you can see here. But their actual impact, per the study that I cited earlier, is actually very hard to know. There are then ESG active strategies. ESG active strategies are those that very intentionally take stakes in corporations and then look to transform those corporations in any number of ways. Their intention is, in fact, to be far more engaged in what the outcome of those companies will be. And as a result, their tracking error is much higher and lower. They can trail an index easily by as 25, 30%, or they can, in fact, outperform an index. That would be their purpose. And then ESG impact strategies, where verifiable additionality, verifiable progress on, let's say, carbon emissions, on any number of DEI objectives, where those can be measured, have a much wider outcome relative to returns as a percentage of an index. But as you go on to slide 2, what you realize is what I meant when I said that the ESG strategies are underallocated to impact. Of the more than 45, in this case, $46 trillion of ESG equity strategies, what you realize is 85% of them are in those ESG index strategies, the red dot that we saw earlier, and only 6 trillion are involved in ESG active strategies, 13%, and something less than 2% are actually in impact strategies. So what this shows you is that the likelihood of ESG index strategies of producing the knowable impact is very, very low. We must move assets from the red bubble to the green bubble to improve impact. That, of course, is equities. If you go to slide number 3, we can look at fixed income. And this differs not on the x-axis, where impact, once again, is described in a continuum from unknown to known. The return is described as a percentage of coupon. At issue, when one purchases a fixed income security, everyone knows your upside. Your upside is that you're going to get your principal back and your coupon. It turns out that default rates for investment grade are very, very low. So you can see that non-ESG investment grade, which is the red square, has a return something in the order of 93, 94%. But again, the impact of those on one's various environmental or social goals, very much unknown. Similarly, ESG blend and investment grade green social impact and sustainability bonds, they actually have the same credit quality as non-ESG investment, as you can see, because the return as a percentage of coupon is operating in a very limited space. But their impact is much more knowable. And anyone who has read my book understands that I am quite enthusiastic about the implications and capabilities of green social impact and sustainable bonds for achieving very specific outcomes while returning market rates of return. But again, if you go to the last page of the slides, thank you very much, what you'll see is, once again, we have this same underallocated problem. There's about $100 trillion in non-ESG investment grade securities outstanding, and yet only around 1 trillion of investment grade green social impact and sustainability bonds. So once again, my suggestion, it is a relatively modest one. It is summarized in the 1.6% solution, which, David, we can come to in Q&A, is to reallocate, implore, in particular, institutional asset managers and ultra high net worth individuals to think about transferring some of their assets from the red circle to the green circle. And in the case of fixed income strategies, I believe one can be highly confident about the ability to have market rates of return and knowable impact. I'm equally confident, incidentally, about a number of real asset strategies, as well as venture capital and private equity strategies, all of which I discuss at some length in the book, as well as point to on my website, www.1.6, which we'll talk about later. Thank you for showing those slides, Nuray, and we can go back to appreciate it. So the third point I'm going to make before opening it up as promised to Q&A is that optimally inclusive, sustainable economic growth is not just a business and finance imperative. It's an all hands imperative. It's an all hands challenge. I don't know about the rest of you, but I listen to most of Ezra Klein's podcasts, and he always asks at the end his guests for 3 books that they would recommend. I'm going to give you my 3 books right now that you can consider as they help illustrate this very important point about sustainable economic growth being an all hands challenge. The first is Unsettled by Stephen Koonin. Stephen Koonin, of course, the former provost of Caltech and Undersecretary of Energy. Stephen Koonin has written the definitive book about what climate science tells us, what it doesn't tell us, and why it matters. Second book is Steven Pinker's The Better Angels of Our Natures, Why Violence Has Declined. But broadly speaking, as everyone knows, Steven Pinker is a very gifted author at reminding us of how humanity is in fact flourishing, making much more progress than we've given it credit for. And I'll talk about that in a second. The third book that I would recommend, but it's actually anything by this author I would recommend, is Vaclav Smil. Vaclav Smil's most recent book is How the World Really Works. But you should also read Numbers Don't Lie and his extraordinary book, Energy and Civilization. The broad thrust of all these three books combined can be briefly summarized as follows. Humanity has, in fact, made unprecedented economic, social, medical, educational, welfare gains over the past 5 decades. It's absolutely extraordinary how much progress has been made. Here's a couple of statistics to consider. In 1980, approximately 1 out of every 2, 46%, of human beings lived in abject poverty. That is to say, under $1.91 a day. 46% of the globe. Today, it's about 10%. Before COVID, it was actually moving back to 8%. When you actually put that into real terms, since 1990 up until COVID, 128,000 human beings escaped poverty every day. Every day. I find that a stunning statistic. In the United States, our benefits have been even more extraordinary. Gen Xers have seen per capita income grow by 4x during their lifetimes. Boomers, I'm a boomer, have seen per capita income grow by 5 times during my lifetime. It's extraordinary. In the 19th century in America, per capita incomes doubled in 100 years. They have actually been growing twice as fast in half the time in the last 40 years. These things would simply not have been possible without global market capitalism. And importantly, without all of the negative externalities, including what we're doing to our environment, including how we have widening income gaps and widening wealth gaps, which I consider to be problems. I believe those are unsustainable problems that need to be resolved. But also remember that all this improved financial abundance has translated into extraordinary social gains. Global literacy rates have doubled. Life expectancy has expanded from 56 years to 72 years globally. Infant mortality has declined by 10-fold. And immediate access to information around the globe has gone from about 0 in 1980 to 80%. The amount of information and ability that people have today to participate in the larger world is just extraordinary. The point of all these statistics is that we need to remember that we've been doing something right. Extraordinary progress has been made. We should not be throwing every single process out and starting over. Global market capitalism has delivered extraordinary increases in human welfare. But that's yesterday. What are we doing about tomorrow? What are the remaining challenges that humanity has as abundance has increased and as we are clearly drawing upon our lands, our air, our water in ways that are destructive to multiple habitats, destructive to multiple species? What do we need to do now differently? How are we going to do those things differently? I call this tripartite challenge inclusive, sustainable growth. It turns out the global economy does need to continue to grow, in large part because the human family is still expanding. We will have 10 billion souls on the planet by around, let's say, 2080. That's up, by the way, from 1 billion in 1800 and 2 billion in 1900. 5 times more human beings who are living much more abundantly, much more, frankly, unsustainably. To try and compare our world today to centuries gone by is really an unhelpful way of thinking about our challenge. So we have to find a way to continue to grow, but do so in a manner which is more inclusive and more sustainable. This is going to require a bunch of public policy changes. Again, I published an article yesterday in Real Clear Politics on about a dozen of those, what I call sensible centrist solutions that range from education and immigration obviously to energy, and what we're going to be doing about our global aging crisis. We live in the age of aging. Here's a statistic. In 2050, America will be spending $1 trillion a year on the 30 million Americans who have dementia or Alzheimer's. We will spend $1 trillion in 2050 just to support those members of our family that can no longer take care of themselves. Stunning statistic. How are we going to afford this? How are we going to be able to do these things without continued abundance? Another area that I'm particularly optimistic about, and then David, let's go to questions, are organizations that I call exemplars of hope. What are exemplars of hope? Exemplars of hope are, and I have in the appendix of my book, I know we're supposed to be talking a little bit about the book, I highlight more than 24 NGOs that effectively have proven methodologies that clearly unlock log jams, whether or not it's recidivism or illiteracy, particularly in the United States, people who have no access to credit. This is Operation Hope that I'm thinking of, allowing people to become first-time homeowners, which is one of the more important ways that Americans can build private wealth. The George Kaiser Foundation, extraordinary human being in Tulsa, Oklahoma, that is providing through private funding all of the educational and nutritional needs for every single child that is born in Tulsa, Oklahoma in perpetuity. George Kaiser Foundation, extraordinary. So the idea that business and finance have important roles to play, yes, they do. They have to continue to provide for the abundance that we all know we're going to need to improve the lots, not only of those who are living and have not enjoyed abundance, but also those who have yet to be born, and ideally do so in perpetuity. Obviously, another NGO I talk about, David, is the Environmental Defense Fund, which is doing extraordinary things to bring carbon footprints down and leading into any number of social and environmental advancements. 12:42, David, that's about where I thought we were going to come in on, and hopefully we can use our remaining time together to have a good discussion.
Thank you very much. And Suresh and I are looking forward. We've got lots of questions starting to come in, and please add your questions. And there's so much more in this book. You all have ebooks that are provided by the Gabelli at Fordham people, so please take a look at it. But it's a sobering topic. It's an all-hands topic, as you mentioned. And I'm just curious, you talk a little bit on the book, a little uplifting, maybe a country like Norway that's doing things well to describe a little bit, but then China, Brazil, India, Russia, Africa, where do we have concerns? Wonder if you could elaborate a little bit on those areas.
Well, I think maybe the important thing to talk about there, David, is how climate change is creating dramatic winners and losers. Canada is in the newspaper today. Canada has, as does Russia, extraordinarily high levels of CO2 emissions. Unsurprisingly, those are two countries that will benefit broadly from global warming as they end up with more arable land, longer seasons, the ability, quite frankly, to mine more materials and access more materials. There are winners and losers from climate change. I struggle with the claim that climate change is a human extinction event. It's not a human extinction event. It's a human winners and losers event. And of course, as always, the poorest countries end up bearing the worst of it. I would be remiss not to point out that for decades, economists have said the solution is a carbon tax. This is obviously what led to the Nobel Prize for Bill Nordhaus from Yale, and all the work that was saying, if we just have the right price signals in, we have a carbon tax. We have one right now. It's one of the great gifts, he says, with a sense of humor, that Vladimir Putin has given us. Vladimir Putin has given us three things that we could never have gotten on our own: Republican-Democratic unity, NATO unity, and a carbon tax. This is what carbon tax feels like. Prices go up, food becomes much more expensive. Here's a Vaclav Smil data point for you, David. There are 5 tablespoons of diesel oil every house tomato that you consume in January in the Northern Hemisphere. That's how much energy is actually required to make one tomato by obviously fertilizing it, growing it in a hothouse, and delivering it to your table. The point I'm making with that is that energy is such a critical component of our lives that it's here to stay. One of the mistaken ideas that protesters have is that somehow in the West we can name and shame ExxonMobil, British Petroleum, and Shell Oil into solving our problems. 3/4 of all the oil and gas in the world, David, is under the direct control of state-owned enterprises, under Rosneft, under Putin, under Maduro, under the Saudis. All these ideas of telling our Western producers, which by the way are part of our national security, that they must stop, when you have literally no control over what it is that Putin is doing, no control over, this is true insanity. I mean, it is absolute insanity. We need our energy champions for national security purposes, and we need to accelerate our move to less carbon intensive energy sources, which, by the way, many of those same petroleum companies, like Occidental Petroleum, are leading. There you go.
Okay.
Questions come.
Yeah, Dr. Jillian asks, this all sounds reasonable until the distribution of shareholding is taken into account. In 2022, 89% of adults in households earning $100,000 or above own shares, 79% of those with post-grad education, and it drops to only 25% of those earning less than $40,000. Is this of concern to you?
Well, I would ask Dr. Jillian, you said? I would ask her, does she think that, in fact, those assets and those companies would be best stewarded, that is to say, best kept on a optimally inclusive, sustainable growth path by the shareholders who own them, or by folks who are not voting? I think that if you actually look at, I looked at Exxon's share ownership yesterday, David, it turns out 82% of Exxon shares are owned by retirees. That is to say, they are either in IRAs or in specific pension plans where people are counting on those dividends, counting on the continued, for their own financial independence in their golden years. So I guess what I would say, Jillian, is, what is the alternative that you suggest? I believe strongly in a wealth tax, which I talk about in my books. I believe strongly in a much more radical approach to how we're doing education in this country, explicitly regarding inner city education, where we are failing our children miserably. If we actually attack those problems while the economy continues to grow, while these corporations continue to succeed, and we take their beneficence, we take their financial success and spread them out, as Henry Ford did in the state of Michigan, I think we'll all be better off.
Thank you, Terry. Thank you, David. Sorry that I dropped out for
we
a second.
We didn't notice. If you hadn't said anything, we wouldn't have noticed.
A number of very good questions here. So let me pick up one of them. Here's a question from Michael Scanlon about some of the investment theory that we have learned before about the modern portfolio theory and investors holding a large diversified portfolio. What's your thought about that theory and what we want the shareholders to do now in terms of focusing on some of these issues that you talked about?
Well, I don't believe, David, that we're going to need to review any of our approaches to portfolio construction. I actually believe we just need to remember the very good ones we've already learned. It is extremely difficult to beat a broad diversified index. In fact, only 1 out of every 7 asset managers has been able to outperform the S&P 500. Why? It's really, if there's one word I could change in finance, it is the reference to indices as passive investing. Indices are anything but passive. 20% of the corporations of the S&P 500 get rolled out and renewed every year. You must all remember what happened to Tesla in December of 2020. They had never been a part of the S&P 500. This is why I spend a whole chapter in my book about how indices are created, renewed. I jokingly refer to the James Carville quote that you all remember when he was serving Bill Clinton. He said he didn't want to come back as the Pope, but he didn't want to come back as a 400 baseball hitter. He wanted to come back as the bond market. I said, now that central banks can change the shape of the yield curve and do whatever they want with bonds at a moment's notice, you don't want to be the bond market anymore. You want to be an index provider. They have become the most powerful people. Actually, I had an event here last week, and Henry Fernandez was sitting right there. And I said, you know, what you really want to do is come back as Henry Fernandez. He's the most important person in the world. As you know, he's chairman of MSCI. The reason why I go to some length to give that as an answer, Srees, is that I believe that this effort to exclude stocks in, for example, temperature-aligned funds, where only about 300 corporations qualify within the S&P 500 for inclusion, you are actually taking out almost all of the corporations that have the greatest probability of transformation. A temperature-aligned fund is misconceived for two reasons. One, you are almost certainly going to end up with a less efficient, less robust portfolio of securities. But two, you're not even going to get a temperature-aligned world. If every single asset in the world were invested in a temperature-aligned manner, it does not create a temperature-aligned world. The idea that there's causality in that direction is simply incorrect. So just so everyone knows, most of my investments continue to be very broad indices. Yes, I do have some ESG strategies, but they're all fixed income strategies, which I've spoken about.
So earlier, I referred to your buyers beware regulators. And so Delphin wants to know, what is your opinion on the SEC's proposed climate disclosures? I'm not sure if you're familiar with them or, you know.
Yeah, no, I am, and I appreciate the question. Listen, as someone who grew up in finance, as you said, 40 years, what investors always want is more information. They just don't want that information to be, let's say, jargoned. In actual fact, the intention of SASB and any number of other accounting mechanisms or accounting initiatives that have tried to bring more information to the fore will help investors make better decisions. They won't necessarily, you know, David, result in, okay, this is bad information, so I'm not buying that stock. Another quote that I have in the book came from Ray Dalio. Sometimes lousy stocks are the best investments, and sometimes great stocks are the worst investments. It all comes down to valuation. And of course, what we've seen principally in the last year and a half, is that all of these tech stocks, which were trading at nose-bleeding levels, have come back down to earth with the rise of interest rates. And of course, all of these mineral companies, oil and gas companies, which have been given up for loss, have fundamentally outperformed. One can understand why that's happened. But the climate disclosure rules, I think, will be helpful in making sure that we have more information. I would agree with the recent decision made at BlackRock and others that Scope 3 emissions are a bridge too far, probably very difficult to actually estimate. There was an excellent article, though, in Bloomberg today about how one needs to be careful, David, on various accounting mechanisms that are now being used by, say, the likes of Procter & Gamble and others, who are effectively counting the purchase of RECs, renewable energy certificates, as against their particular emissions, even though those particular purchases are not resulting in the generation of additional renewable energy. So the need for better accounting, clear accounting, more transparent accounting on carbon footprints is something that I think we should all welcome.
Thank you, Terry. Here's a question from Tom Higley. If ESG is meant to be an investment in long-term shareholder value, what has gone missing in the more discerning allocation of ESG investment to opportunities that include both long-term return on investment and impact?
I think so. This is an excellent question, and what I would say, the person's name was David. What was the name of the person who asked?
Tom.
Tom, I think this is really a wonderful question, and I'll tell you why. And I'll illustrate it with a story. Everyone probably remembers the Volkswagen diesel scandal. Volkswagen was actually lying, fabricating information about what the emissions of its cars were. And of course, what happened at that precise moment is everybody threw Volkswagen out of their portfolios. These are evil, horrible human beings. Get rid of your Volkswagen shares. That, of course, was the time to buy Volkswagen. Those who were watching the stock and their behavior very, very carefully and closely realized that over the next 12 months, Volkswagen actually applied for more green patents than any other automobile company. And of course, when they were coming out with some of the advantages that they had invested in over that period of time, the stock absolutely flew. So the point is that I am somebody who, as you can tell, is fairly dubious about ESG indices, ESG indexes outperforming, because they're all about excluding, reducing one's opportunity set. When in actual fact, a intelligent, spirited, hardworking equity analyst will be seeing underneath the hood that, my gosh, here's a company that is fundamentally transforming, or buy into a number of these sustainable investment themes. And another company I wanted to talk about was Schneider Electric, which is an Indian company. Stock is up 300% since 2019. Not many stocks that are up 300% since 2019. What does this company do? Well, it creates and in fact advises on the implementation of automated heating and lighting devices that turn off all the lights and turn off all the heat in a building when there is no detection of human activity, and uses obviously AI and other types of to predict when those heating. The whole point is this ability to actually improve bottom lines, to actually reduce carbon footprint by just being more mindful of our environment. This is a very important investment thesis that you can buy into and benefit from. I am not a Vivek Ramaswamy adherent on the claim that excellence has nothing to do with ESG. I would say sustainability as an investment thesis, circular economy themes, these are going to continue to be winning investment themes, winning, that is to say, outperforming market indices.
So we just have a few minutes left. I think you might have some concluding thoughts, Terry, or...
Yeah, I just wanted to say, David, if I could, that I think this debate about the role of business and finance in creating a world of optimal inclusivity and sustainability is not going away. It's here to stay. It was for that reason that I was very grateful for the endorsement that my book received from Professor Aswath Damodaran from NYU's Stern School of Business. I know, Sri, it's a competitor, but Professor Damodaran, as you know, is a great critic of ESG. This was his written quote from my book. While ESG is an acronym may and perhaps should fade, the question of how to balance profits and virtues will stay with us. Terence Keeley's Sustainable will help us work our way to an answer. That was the intention of the book. The intention of the book was saying, okay, I'm not a climate denier. We do have problems. Business and finance has a critical role to play. Let's understand what that role is and is not. By the way, when he says that that will help us work our way to an answer, that means everyone on this call. And if you could just pull up my last slide, I would just like to invite everyone who is listening in to visit my website. This is www.1point6.com. There, it's a very interactive website. If you have any exemplar of hope that you'd like to nominate, or by the way, any investment strategy that you believe verifiably does well and does good, we receive 24 ideas a week, and we are doing capital introduction for the very best ideas. We found that it turns out a website was needed for the exchange of both opportunities, capital being invested, and investable opportunities looking for capital. You can nominate those. But more importantly, I'd invite you all to join the Solutions Forum, which is an active, open platform, dialogue platform intended to put Twitter out of business, where all we discuss are principles and policies and solutions to promote more inclusive, more sustainable economic growth. We would all benefit from hearing from you. So that's what I had to share, David. And again, I want to thank you for the opportunity to participate.
Thank you, Terry. Thank you very much for a very thought-provoking discussion. We had many more questions that we couldn't get to because the 1 hour passed very quickly. So once again, thanks everybody in our audience, and please join us for our next webinar on November 8th. It'll be by Joe Calandro, who will speak about personal finance and financial wellness. Until then, all the best.